Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the boys from Convoy, Dustin, Jonathan, or as I sometimes joke, Justin. It makes me laugh when I say that out loud. How you guys doing?
Good, good. How are you?
I'm doing well. We got three topics today. Folks, you got to pay attention to episode number 2. We're going to announce something that I said the first person to do this wins, and the boys from Convoy appear to be coming home. So that's a little tease for video number 2. What I want to do here in video number 1, guys, is I want to give a little education to the audience. Something that's going on in the lending market is we have this thing called QT by the Fed, quantitative tightening, not quantitative easing. And just to the ordinary mom and dad on the street, we hear things like liquidity is drying up. And, they may think they know what that means because, again, the words by themselves, kind of easy to understand. But in practice, I don't really think they know just how fast liquidity is drying up and where they might see the changes. So, guys, do me a favor. When I say liquidity is drying up, tell us what it means to you as lenders and then what, the average person might see. Sorry, Dustin.
Yeah, something stuck.
Yeah.
Yeah, I mean, liquidity drying up is, the fact of the matter is, the banks and everyone, they have the money to lend out. They always have, it's the government, so they have unlimited money. But when there's a tightening up of the economy and liquidity in general, the regulations to lend become tighter. The rates go up, obviously, as we're seeing, and the banks just are more apprehensive to lend to riskier borrowers. So the money that actually goes out doesn't end up being like, if you could get something, that was easy, let's say bank statement or non-QM loan sometime, in the last 2 months, if it continues to tighten up, then it may be harder and harder to qualify for a loan because the guidelines are going to get stricter and stricter to restrict, people from that writing, riskier loans.
Yeah. Yeah, when I look at the situation, the money's always there. It's just who can get basically who gets a yes answer. That's what I think. And if you've been in the game less than 10 years, you really haven't seen this coming, right? We're entering a bear market in the stock market, a recession in the economy, and higher rates. But really for me, it's not the higher rates that get most people. It's the tightening of conditions. Or said another way, you know what? Yeah, we can loan to you, but we're not going to do 80% LTV. We'll do 75. Or we'll not do 75. We'll do 70. We'll not do 70. Because again, in my experience, banks or lenders in general very rarely want to say no. It's kind of like not yet. They just change the criteria. And sometimes you just don't see it coming. Is that fair to say? What do you think, Dustin?
Yeah, I mean, that's all already happening. We for pretty much all of Q1 of 2022 and all of 2021, pretty much every non-QM lender was offering 85% no matter what on a purchase. Q1, everybody was doing 80. Now, only a handful are doing 80. Most are at 75%. So like the tightening that we can use that would translate, it's tightening really of how much leverage these banks are now willing to give to any future homeowner or investor compared to what it was when, the economic situation obviously wasn't where it is today. And, it's something that we have to keep a close eye on daily because we've got, over 100 different, investors and partners that we work with. So they're always changing, and there's always going to be one that tries to kind of clean up on the, I guess, market that's trying to get 80% loan to value. They may be the only people that do it for a month and then they'll rotate. But we're already seeing that.
Yeah. And when I think about liquidity drying up, it really is, it really hurts kind of the new investors, right? That kind of built a model. It really hurts too. Like if you built a model where you're a flipper and you don't have a lot of capital and you've got it all out, they're just trying to slow you down, right? Again, less money means less deals. The other thing that I have seen, and I'm sure it's crossed your radar, is we've seen a couple of non-QM lenders shut their doors in the last 30 days. Yeah. And again, what is that all about? Well, my opinion, I'm not in the business. Don't want to I don't want you guys to throw shade. but I can throw shade. These are operators that built their operation, frankly, too fast. They built an operation that was only stable in the loosest of loose monetary policy. And as soon as the tightening hasn't even been all that bad, and these people went out of business because their freaking overhead was whack. My opinion, not yours. But again, when you see non-QMlers go out, it just the business gets, this is what I told you, I think 3 months ago. I think Convoy is going to come out of this awesome because you're right-sized and you're doing the right thing by your, you weren't built for, you weren't trying to grow at any cost. So I don't know. I'm sure you guys saw it. Some non-QM lenders go bust in the last, 30 or 60 days. Others probably on their doorstep. What do you think's going? Do you think the non-QM space gets smaller in the next 6 months because of this?
I think the amount of players in the non-QM space 100% is going to get smaller. Like you said, it already happened. Last week, I want to say the second largest non-QM lender, Sprout Mortgage, closed doors out of nowhere. It was funny because, John and I get emails all the time about product updates from lenders and whatnot. And 2 hours before they closed doors and laid everybody off, no severance, didn't pay anybody, they sent a mass email out saying, we're the one-stop shop, the best price, send everything to us, literally 2 hours before the news of them shutting down. And then the week before, another pretty big, I'd say in the top 10 FGMC mortgage company or corporation they go by, they're owned by PIMCO, who's a big player on Wall Street as well. They shut down too. And a lot of it comes from the fact that there's non-QM players that will sell their loans and try to make a premium on the secondary. Then there's a lot that'll service them as well. Those players that are selling them on the secondary, those margins are too tight. They're selling them at a loss and they can't withhold or withstand. Let's say on average, Sprout was doing like 500 million a month in non-QM loans. They were selling this at a 2 or 3% loss on 500 mil, right? So that's month over month, 4 months, you're draining, let's say 3%. That's like 60 million you're losing from originating loans. From closing loans, you're losing 60 mil.
Oh,
so that's something we're keeping a close eye on. And John would agree. And we're trying to obviously make sure that all of our clients are not going to those that are in that type of situation.
Yeah. Yeah. When you, second largest non-QM lenders business model was to lose 2 or 3%. That works when money's free. When you can raise debt because you have a heartbeat, that's when it works. When that heartbeat stops, your days, weeks, months, just depends on how much cash you have on the balance sheet. This happened in the .com crash. This is not new. I've seen this stuff before, but Sprout Mortgage, great job. You're the best. And 2 hours later, you laid everybody off. No severances. Not cool. Yeah. Jonathan, any kind of closing thoughts on the space and where non-QM goes and why Convoy is really positioned to do quite well, frankly?
Yeah, I think it's very important for just, for your listeners and just everyone else to just understand that the market is going to continue to do this, right? And we've seen lenders pop out of nowhere and become lenders all of a sudden during the boom. We're going to see lenders start to shut down the same way. And it's already happening. So, make sure that, you guys are really looking into who is doing the lending, right? Is a lending partner that you're working with to do the loan, are they trustworthy? Can they actually get the job done? Because a lot of people right now in this market are going to say they can do non-QM, but not actually be able to close it. Yeah. So, are you working with someone that's actually going to be able to help you close these deals? And then obviously you can always reach out to Dustin or myself on private client at convoyhomeloans.com. And then let us know that you're calling from ORAT, and we'll reach out and kind of discuss, and we can kind of see what you're going through and then make sure that you're in the best position possible.
Yeah, do yourself a favor, reach out to these guys, private client at convoyhomeloans.com. Let them know you came from ORAT, and Jonathan and or Dustin will take care of you. That is the agreement. That's why they're here every other week. Thanks, guys.
Thank you.